Good morning. I'm here to talk about the Livestock Risk Protection Program and the Livestock Gross Margin Program that are available through the Risk Management Agency of the USDA. I'm Bonnie Lind. I'm based in California. The program that I write as an insurance agent, USDA's Risk Management Agency, is serviced through insurance, approved insurance providers that are in agreement or under contract with the USDA. And it's delivered through agents like me, sold through appointed certified livestock agents. So I have to go through training on livestock insurance programs in order to be qualified to sell this program. And then it's provided through specific in exchange for premiums. So it's not like grants or other types of programs that you get paid through FSA. We're kind of a sister agency with FSA, and it includes a cost sharing where you pay a premium in exchange for the coverage that you select. The two programs I'm going to talk about today are the two at the top. The Livestock Risk Protection Program is designed to insure against a decline in market prices, and then the Livestock Gross Margin Program, it provides a protection and management ability for margins. There's also a Dairy Risk Protection Program. We're not going to cover that in this presentation. So under the Livestock Risk Protection Program, it protects against a decline in market price, as we stated, and that would be a decline below the amount of coverage that you would select. Covers against unavoidable causes of loss driving that price downwards. The producer selects a coverage price, and then the insurance period ends near the date that the livestock is normally marketed. And at the end of the insurance period, the coverage price through discovery is compared to the actual ending value published by the RME to determine if there may be an indemnity due. And then under the Livestock Gross Margin Program, LGM policies provide protection against the loss of gross margin for the commodity. The RME publishes separate policy documents for cattle, dairy cattle, and swine. Producers with any size farm operation can produce an LGM policy as a risk management tool. You have to be eligible to participate in federal crop insurance programs. You have to report your tax ID numbers as part of the sign-up requirements. Premiums are subsidized. You must have a current highly erodible and wetland conservation compliance certification form on file at the local farm service agency. They're the ones who manage and update those. A one-time exception is available for first-time farmers. People who just start farming can have an exclusion to that conservation compliance certification. And it's an actual pretty simple form to fill out. If you've participated in FSA programs in the past, you probably have one on file. And if you're not tilling the soil and planting annual crops, it's generally an easy process of checking a box and signing at the end of the form. If you're a beginning farmer and veteran farmer, you're eligible for an additional subsidy or additional discounts on your premiums of 10%. And you have to meet all their program requirements. But like I said, if you are just farming, just growing cattle, then and not farming annual crops, generally the process is pretty simple. And this handout is also in their folder, right? All these slides are in their folder?
Yes.
Okay. Okay, under livestock risk protection coverage, it's established under one or more specific coverage endorsements. It covers, like I said, unavoidable causes of loss driving prices downwards. And you select the coverage price. Insurance period ends near the date the livestock are normally marketed and sold. So you're kind of looking at the different length endorsements when you go onto the rma.usda.gov website, which is where the prices are published. At the end of the insurance period, the coverage price, like I said, is compared to the actual ending value through discovery that's published by the RME to determine if any claims are payable. Here are the types of and descriptions of commodities insured under the Livestock Risk Protection Program. Feeder cattle are described as steers weight 1, steers weight 2, heifers weight 1 and 2, Brahman weight 1 and 2, and then there's the dairy cattle also. These are, these should be in your folder. And then here's unborn feeder cattle, fed cattle, and swine types, also insured under this type coverage that we're just talking about right now. So there's some limits. Generally, most growers won't hit that here, but you can insure up to 25,000 head per year, and that would be 12,000 head per endorsement that you decide to apply for and put coverage on for a different coverage, for a specific coverage period. There's no minimums. If you felt like you wanted to sign up for this program and start with a few head of cattle to see how the program works for you, that's totally fine. So the LRP application for coverage must be submitted to the insurance company by the LRP sales closing date. And we have a real tight closing date. Once you see a published price that you like, you have until 9 a.m. Central Time the next morning to get an application in. So we encourage that, and the sales closing date is the specific coverage endorsement closing date. We suggest that producers who are interested get the application into an agent. Whether or not you want to participate with an endorsement, that's up to you. The premium isn't charged or due. There's no coverage offered until you actually get your endorsement attached. So it's good to get the paperwork, most of the paperwork done up front, then start looking at the USDA, the rma.usda.gov for pricing. So sign up now, and then look at the pricing and decide if you want to add an endorsement. So several different things go into determining the premium. It's the commodity, your share, the cattle type, target weight, number of head, desired coverage price or level, and the endorsement length. Endorsement lengths start at 13 weeks and go all the way up to, I believe, 43 weeks. So the target weights are how much a producer anticipates the animal will weigh at the end of the specified coverage endorsement insurance period. So for feeder cattle, weight 1 is 100 to 500 pounds. Weight 2 is 600 to 1,000 pounds. And fed cattle is 1,000 to 1,600 pounds. You report the number of head you want to insure. You don't have to report all your cattle. You can report, like I said, if you just want to experiment with this program, you can report however many you want to add insurance to. You would need to also report your interest in the cattle. Any head on a policy for which the producer has a 10% or greater interest is reported on your application as well. And any head insured on a policy under your own name. I don't know if there's any share situations here, but if you do have a share in the cattle over 10%, that's considered partial ownership. So you select the LRP coverage price for the RMAs listed from the RMAs listed coverage prices. They are published daily. They change daily, and they're based on the CME applicable ending prices. So anytime we talk about prices under these programs, they are not related to your specific prices, but to the prices that are published on the RMA's website, and the RMA gets those from the CME. Generally in $2 increments, and prices offered during a sales period generally range from 70% to 100% of the CME price. Okay, this is the handout that Melly just gave you. This little blue excerpt that I have is a small part of what you have in front of you. It's an 8-page printed page, and this comes directly from the RMA's website. And it shows, like, if you had looked up these prices yesterday and were considering getting insurance to attach today, for Hawaii, it shows feeder cattle, steers weight 1, the endorsement length of 13, which is in this column. This is so many pages because it shows all the possible endorsement lengths and different cattle weights. But if you look across the top line, the endorsement length of 13 for feeder cattle, steers weight 1, would have an expecting end value of $227.96. And so your coverage price would be, it's around 90%, 99%. It would be $227.39. So that's one of your highest coverage prices. It goes down. If you go down, it'll go all the way down to, I believe, $227. Actually, that whole column is the same. Oh, the coverage prices go down to $207. And then it shows the coverage levels. They range from 99% down to about 91%. The rate is 3% down to 0.3%. And the cost per hundredweight is around $6.91 or all the way down to 67 cents for the lowest coverage level. Your producer premiums are shown in the next to the last column of $4.49 per hundredweight all the way down to 41 cents for the lower coverage level. And this has an ending endorsement date of June 9th. So this is what you'll see when you log on to rma.usda.gov and you start looking at these to see if there's a good price that you think you want to lock in at. And again, these are CME prices, and the actual end value will be a discovery value of CME pricing also. The subsidy factors are consistent across all cattle types depending on the coverage level. So if you insure at the 70% coverage level, for instance, you would have a subsidy factor of 55%, meaning you'd be paying about 45% of the premium. And this actually shows on the cost, it shows, I don't know if this reflects the subsidy or not. I'm not going to say that it does. But anyway, just know that your premiums are subsidized all the way up to about half of what the coverage cost would be without the subsidy. Here's an example. It shows 100 head of cattle with a target weight of 6.5 hundredweight. Coverage price in this example, it looks like it's kind of dated at $153 per hundredweight. With an insured value of about $99,000, the rate is 1.2% for a total premium of about $1,219. Subsidy factor in this example at the, doesn't say the coverage level, but the subsidy factor in this example is 40%. Which we would take off of the gross premium, leaving a net premium of $731 in this example. And the cool thing about crop insurance is you never have to pay for it up front. You can pay for it after the end of your coverage. You wouldn't get a bill until maybe the first day of the month following the end of the insurance period, and then you have a certain time frame after that to pay your premium. So if you had a claim in there, if you had an indemnity payment, they would just take the premium out of the indemnity payment. This is the cost estimator tool on the rma.usda.gov website, where you can actually plug in your data if you'd like to estimate your own premium. You could also work with an agent like myself, and we would help you get an estimate on your premium. So specific coverage endorsements establish the coverage on the commodity for the SCE period. They're established by commodity and class, and they're established by length of time that the insurance period of the insurance is effective. You can have multiple SCEs in a single crop year under one application for different commodities or types on separate SCEs in the same county on the same day, and for the same commodity in the same sales period. And there's some exclusions. One of those is you have to have different coverage links on the endorsements that you attach on similar types of cattle. So you can kind of mess around with different ending dates when you're looking at these coverage prices that are being offered, and make a decision on, if you want to add multiple types. You just can't have really overlapping coverage on the same cattle. So insurance availability is sometimes suspended. When you go to the RMA's website, there will be notices posted about a single day suspension, about a capacity that's been reached on a particular day where the price was just too tempting for growers to resist, and everybody signed up. So there are capacities. So if you do decide to participate in this program, it's a good thing to spend your morning looking at these prices as soon as they become available. Could be multi-day suspensions, usually related to market volatility. And then there's also going to be notices on the website about the sales are resumed. And then loss determinations. The SCE provides insurance for the number of head reported. Certain situations require you to report and provide in a written notice within a specified time period that something's happened. So the policy requires that you provide a written notice within a 72-hour period of learning that you have had a death of livestock, and that is in order to retain your coverage on the remaining livestock and on the livestock that were lost. So if you had livestock seized or quarantined, you may have an adjustment downwards if you didn't report. If you didn't provide ownership records, the company could reduce your coverage. The weight of the insured livestock is below the minimum allowed target weight. Producer disposes of livestock early, more than 60 days before the ending of the endorsement, or you lack records, or the producer, and in all these cases, you would still be responsible to pay your premium. So just stay in contact with your agent if things are happening that change your plans related to how they were when you first set up the endorsement. So the ending value, if it's below the coverage price, once it's published on the website, then the company would pay an indemnity for the difference. Here's an example showing a grower locked in the price of $95.40 for the specific coverage endorsement period, and the actual ending value was $89.58 per live hundredweight. So there's an indemnity due in this case. And these are the resources. The main one is the rma.usda.gov is where you start looking at the prices for the cattle that you want to attach an endorsement to. That's the LRP program. Any questions on that? It's pretty simple. This is an oversimplification on the program. There's a lot more details, but if you decided to work with an agent, you could get more details on how the program works. Livestock gross margin covers several different commodities: cattle, dairy cattle, and swine. The gross margin defined for cattle is the market value of the cattle minus the feed or cattle costs. The feed amounts are stated in the RMA's information browser again, so you would see a different set of tables for the LGM program, and it would state the specified amount of feed depending on the commodity type. Death, destruction of the commodity, unexpected changes in feed rations for cattle, or other losses are not covered under this. And then the sales period for all LGM policies begins on Thursday of each week. And this is another one where it's very time sensitive. You have to have an application turned in by 9 a.m. the next morning. So I would suggest being in touch with your agent on that Thursday to get it all done on Thursday because of the time differences. So the effective date for policies purchased during the sales period is that Thursday. It begins on Thursday. You're locked in on the Friday following, and then the sale date and policy effective date for all policies purchased during the sales period in this example would be July 14th, which is the Thursday. Sometimes coverage is suspended on this type of policy also. Sometimes always due to holidays, and then there can be multi-day suspensions again with price changes that exceed the limits that the RMA establishes for that purpose. Sales periods reflect CME market settlement information, include information that the market is volatile, news reports that cause market volatility. And if there are no offers published on the RMA's website, then you can't sign up. So these policies have 12-month periods. They're actually an insurance period of 11 months, and they're staggered depending on which month you sign up. So you can pick your 11-month period, the first month is not covered, and then the following 10 months is the coverage period. Everything's based again on the CME pricing, not your pricing, and they're also based on the futures prices for the feed. I think I just said that. So they use the futures contract prices to determine prices and feed costs in specific units of measure, either the live cattle weight or the feeder cattle and corn bushel prices. They determine expected prices based on the futures, sometimes using a weighted average. They have all sorts of formulas where they determine that information. And then they determine actual prices at the end of the coverage coverage period based on the same type of data input. Actual prices are used to determine whether there's a probable loss. LGM cattle, the expected feed amount varies by the type of operation, and the amount is calculated per head or hundredweight. Here's an example of showing yearling finishing. The published amount of corn feed amount per head is 50 bushels. There's an expected corn price of $4.50 per bushel. And in this example, the expected cost of feed per head would be $225. The RMA's gross margin data is published in their information browser. And the livestock reports are also available at the rma.usda.gov. There's a quick, simple button to push on their homepage for livestock reports. Here's an example of how the livestock or expected gross margin per head is established. We take the price of the expected live cattle price for April times the live cattle weight to come up with subtotal A. And we look at the corn price and the amount of feed that type of cattle would be required to have, and that gives us subtotal B. The expected feeder cattle price in November, assumed weight of feeder cattle would be subtotal C. So we would take subtotal B and C and subtract it from subtotal A. That gives us the expected gross margin per head. Expected gross margin of $230 in this example, $230 on 10 targeted marketings. And you can also select the number of cattle that you want to insure under this policy. It would give you an expected total gross margin of $2,300. You can insure multiple types of cattle, and you can select a different deductible for each type. So there is a premium subsidy on this policy as well, and it's based on the percentage it's based on whether or not you have insured commodity in 2 or more months of a single purchased insurance period. The premium subsidy percentages range from 18 to 50%, and the subsidy is based on your deductible once you are participating in 2 months or more. This is just a picture of where the subsidy tables are on the rma.usda.gov website. Here's a premium example of a grower selecting a $150 deductible. Effective policy date is February 9th. Target marketings are in November of 100 head, December of 100 head. The coverage would be $22,408, and the premium on this 200 head of cattle would be $1,017. Oops. Oh, I went back to the beginning.
You good?
I'll just, yeah. I think it's almost, we're almost to the end of this. My time's almost up too, right? Here again, we have a premium billing date. First business day of the month following the last month of your coverage period. So you don't get a bill before your coverage is pretty much exhausted. Probable loss calculation is pretty simple. Gross margin guarantee minus the actual total gross margin equals the indemnity due. And again, these actuals are not your actuals. They're the published actuals listed in the RMA's website. These are the resources that we use. And any questions on that program? So you can find an agent that's certified to sell livestock. You can actually search livestock agents on the RMA website. I'm a certified livestock agent. There's not been any participation in Hawaii of these programs. I don't know how well known these programs are by producers, but I'm willing to work with anyone that wants to get more information. We can't discriminate on any basis because we're all governed under the USDA programs. And if you have questions that you want to ask me specifically about any of my slides, please don't hesitate to email me. And that's it. Thank you.
Mahalo and thank you again for watching. I hope the information shared in this video will be useful for your production system. Please take a minute to fill out our feedback or evaluation form by scanning the QR code on your screen or clicking the link in the description box below. Your responses are anonymous and will be used to provide valuable information to our program sponsors and to help support future programs for our Hawaii ranchers and agriculture communities. And then join us August 31st, 2023 for our live Q&A session where you can speak and ask questions to any of our speakers. Mahalo and thank you again for watching.